Foreign institutional investors who were in a massive selling spree for the most part of last year have returned to the Indian markets with a bang. The sentiment seems to have seen a complete turnaround since April 2023. FIIs are pumping money into India in a big way. So what has changed? Why are FIIs now turning bullish on India? And importantly, is this a passing phase or a more fundamental shift in FII behavior? We're going to be talking to Mark Mobius about that. But before we go and have a look at what he actually feels, do take a look at this special report.
The Indian equity markets have seen a lot of volatility in the past year. Although domestic institutional investors were buying heavily, foreign institutional investors were on a selling spree in 2022 and the first quarter of 2023. In 2022, FIIs sold Indian shares worth $17.2 billion, which took their aggregate holding to a multi-year low. But since April, things have seen a dramatic change. April 2023 marked the return of the foreign institutional investors in a big way. Global investors are once again turning bullish on India. FII were net buyers of Indian equities for 14 straight days, the longest in 3 years, tweeted market veteran Nilesh Shah on Wednesday. Global investors bought shares worth $2.74 billion. So what changed? A combination of factors seem to have contributed to this change in sentiment. India's economy has shown resilience despite several headwinds, both domestically and globally. Even if there is some slowdown in growth, India will remain the fastest growing economy in the world. Meanwhile, the Reserve Bank of India's decision to pause rates along with inflation numbers on a downward trend fueled expectations that the central bank would continue to remain status quo on rates for some more time. Added to this, the rising tension between the West and Beijing, along with the fact that recovery in China hasn't been swift, led to a series of ramifications, including investors pulling money out of China. India was the obvious alternative. For billionaire investor Mark Mobius, the biggest allocations are to Taiwan and India. In fact, Mobius says allocation to India will only increase going forward. However, experts are of the view that no assumptions should be made from the recent spurt of FII buying. Instead, FII behavior over the long term should be observed before reaching any conclusions. The Indian equity markets have seen a lot of volatility in the past year.
Well, if you really want to understand what's happening anywhere in the world of financial markets, investing, whether it's investing in India, investing in China, investing in emerging markets overall, perhaps one of the most respected and best-known faces across the planet, Mark Mobius. And he now joins us. It's such a pleasure to be joined by him. Mark, thank you so much for joining us. I'm going to be talking to you about investing in India, of course. But first, your overall sense on what's happening in the world. How are emerging markets looking? Where are you investing? What's the world of investments looking like to you, Mark?
Right. Well, thank you very much for that nice introduction. The overall picture is pretty good, actually, because in the U.S., you're seeing the inflation rate to come down, which will mean that the pressure on the Fed to keep on raising interest rates will be less, and that will give more confidence to the market. So I think that's probably the scenario that will result in a better situation globally, not only for the U.S. market, but for the global market. And if you look at China, you'll see that actually they have been reducing interest rates pretty dramatically in an effort to get the economy in China going. And of course, that's generally good news for many other countries around the world, because, as you know, China is a very big factor in the trade and investment around the world.
Well, Mark, before I come to the inflation and interest rates and what's happening with all of that, you created quite a stir a month or so ago when you said you were not being able to get your money out of China. A lot of people got somewhat concerned by that. What's the situation there? Have things eased out a bit?
Yes, it has eased. I was able to get the money out. It's true that there are officially no restrictions on getting money out of China, but the paperwork and procedures required are quite intense. So I was able to do that, and everything is fine as far as that concerned. And we, of course, will not stop investing in China. We will continue to invest in China, but the situation there is looking a lot better than it was last year, and we're seeing some recovery in that market.
So when it comes to the issues that you had in the paperwork and the other problems, now, there are a lot of people who are saying there are risks there in China, which you need to be clear about. It could be paperwork in this case. It could be procedural. It could be a fresh crisis that comes with capital controls being imposed, golden shares suddenly happening in Chinese companies. So would you say that there are those risks in China, which any investor has to keep his or her eye on?
Definitely, that is going to continue. You're going to see companies diversifying their base of manufacturing and the base of supply away from China into India, Vietnam, Thailand, and a number of other countries around the world. Of course, in the U.S., some of the companies are bringing their manufacturing back home because with automation, they're able to do that without raising costs too dramatically. Nevertheless, China still remains a major supplier of people around the world, a major exporter. I don't see that diminishing, but of course, world trade, the whole globus of the world trade is going to be increasing. So China's share may decrease, but the total will be probably the same or increasing.
All right, Mark, now before I move to other developed markets, emerging markets and India, just take me China for a second more. One of the big questions that's being spoken about for a while are possible disruptions in supply chains. We are seeing that many companies are trying to relocate some of their factories, moving them to other countries, including places like India. Is that a trend that you think is going to continue? And is that going to be a significant enough event with all those geopolitical risks around China? You were mentioning Taiwan. There could be a war at some point. Who knows? So is that an existential question around China, which isn't going to go away soon and therefore needs to be factored into investment decisions?
I don't see a recession coming in the U.S. simply because of the end of higher interest rates to begin with. And of course, the move by the central bank, by the Federal Reserve, to rescue banks. The big problem and the big risk for the U.S. would be a failure of the banking system. And we've seen a number of banks go under, but the Fed was very fast to react and to bail out all the depositors in those banks. And of course, arrange mergers with the likes of JP Morgan and so forth. So I don't see the specter of recession anytime soon in the U.S.
Okay, one of the big questions when it comes to investing that people are looking at is what's going to happen in the developed markets. In the U.S., for example, still concerns. Inflation is still high. What's going to be happening to interest rates? Are those going to be lowered? Could there be recession? That entire fear has not gone away completely. What do you feel? Do you think there could be a recession? Is there going to be a soft landing?
Oh, there's no question. The debt is incredible. And if you look at credit card debt in America, you'll see that it's quite incredible. One of the good things about the higher interest rates is that it put a lot of these people on warning that built up big credit card debt not to do so. And some of that is being cleaned out. And of course, the mortgage market in America is a problem, particularly in the office sector, because with the arrival of Zoom and the arrival of all this remote working, a lot of the office space is empty, and that will create real problems for real estate companies in the office market. But I think all of these problems are surmountable because there is enough money in the system to finance these problems.
Well, the big issue, of course, with the high interest rates that we've been seeing is that it does have a massive impact on the tech sector. We saw that big slide last year. But many people will also argue that tech now has got a lot of value in it, especially after the correction that we have seen and considering all the big changes that we are seeing in AI and other sort of things. There are, of course, now some signs of recovery. NASDAQ up by, 20, 25, 30% in the last 2-3 months. What do you feel about that? Do you think tech is the place to be or other areas?
Well, you have to look at tech in many different areas. You have the tech companies that went public with no earnings and still are heavily in debt and also have no earnings. That's one part of the tech sector. Then you have the hardware sector. Companies like Apple are doing very, very well. Then you have the software sector, and that's divided into many different parts. For example, the companies that we have in Taiwan are doing the software, the design of chips. Then you have companies, many in India, of course, doing software for companies. They're doing that kind of thing. Now, if you look at this whole spectrum, you'll see those companies that are not earning money, that have debt, that went public on the back of the hope of the future, they're going to continue to be in trouble, and they will probably have to go under. But then you have these other companies like the Taiwan companies and the Indian companies that we own are doing very, very well. They have a high return on capital. They're increasing earnings. Those companies will do very well. So I think it's important for anybody looking at the tech sector to differentiate very carefully between where you are and what kind of companies you're looking at.
All right, Mark, let's turn to India now. I know you've been bullish on India for a very, very long period of time, and that bet hopefully has paid off rather well for you. How do you see India right now? Would you continue to put more and more money into India?
Yes, we've done very well in India, thank God. And I think India is very high on my list in terms of the future. We look at India not as a short-term kind of investment, but as a long-term investment, simply because you've got a young population, you've got a government that's moving into the digital age very quickly, and you've got companies coming into India to replace some of the manufacturing they had in China to be in India. So you have a combination of these things which are really very good for India and which will result in a continuing fast-growing Indian economy. We're very bullish on India.
Okay, so if you had to do asset allocation, how would you be dividing up your money right now? How much of that would actually be going into emerging markets and specifically a market like India?
Well, if you look at our portfolio, you'll see that Taiwan and India are the top allocations in our portfolio. I would probably, of course, we have a historical, we're long-term, and therefore we don't turn over the portfolio very much. But probably going forward, the allocation in India will probably increase to 35%.
Hang on, so you're saying you're going to have 30 to 35% of your money in India?
Yes.
That's a really high number.
Yes.
Okay, so that's a lot. And in India specifically, what would be the areas that you would be looking at then?
Well, we are now in the software area. We love Indian software companies. We're also in the metals area, manufacturing metals area, and we're in the healthcare sector. Those are the three sectors which for us appear very well. But the beauty of India is such a huge country. There's so many sectors we can look at. It's not like if you went into some of these other emerging markets, there's really maybe only one or two sectors you can get exposure to. In India, you've got incredible number of opportunities in many, many different sectors. So we're looking at everything in India, but currently those are the three that we're focusing on.
All right, Mark, there's been all this talk of de-dollarization, other currencies coming up, whether it's a Chinese currency, whether it's something backed by gold. Who knows? Perhaps the Indian rupee goes convertible at some point. Do you think this is something that is a really serious possibility that we should be tracking right now?
Oh, yes. It's already happening. That I think the Americans made a big mistake in using their dollar dominance to punish Russia by restricting trade and transfers in dollars. That put a lot of people off dollars because any other country around the world will look at this and say, wait a minute, if I get in trouble with the U.S. government, they'll grab our reserves or they'll do something to interrupt our trade in dollars. So I think that was a big mistake on the part of the U.S. government. And I think more and more people around the world are thinking of alternatives, which is, by the way, one of the reasons why cryptocurrencies continue to do well. And I think a lot of countries are trying to do something to replace the dollar. as a reserve currency. However, it will not be easy. The dollar is still very widely accepted around the world. And the thing about the dollar is it's a free currency. You can trade it anywhere, except if you happen to be Russian. If it's interesting. A friend of mine here in Dubai said he was at the dinner and he saw a bunch of Chinese and they had dollars in their hands, paying out cash in dollars. So obviously, it's popular still.
All right, Mark Mobius, thank you so much for joining us with that perspective. The overall headline I think that we will take from all of that is have faith in the India story and put a lot of your money into India. Thank you so much, Mark Mobius, for being with us.
Thank you very much.